Okay, moving on, we're fortunate enough to have our Managing Director and CEO for the Sequoia Group, Gary Kroll, join us for the warm welcome and official opening of our PD Day session. Thank you, Gary.
Thanks, Mark. And basically, all I wanted to do is introduce the session and thank everyone for coming on. Mark talked to me about having the first session with Matt and a workshop, and I was not completely convinced that the workshop would be as popular as it was, and I must say that Mark was right and I was wrong. And 250 people have already attended the first hour of the optional workshop. So thank you for attending that. Obviously, the content was very excessive and extremely good. So I think what we'll do is we'll definitely follow up on that concept of workshops and get groups like Net Wealth and Hub and the other supportive businesses that we use to support those concepts. So I'd really like to get feedback from the group. How beneficial was that? We're doing some surveys on the speakers, and we'll certainly ask some questions in regards to that. So welcome to the official commencement of the PD Day. As we spoke about last time we had a PD Day, we were apologising for having to have separate rooms in some of the states because of COVID and all those sort of things. So I must apologise again. It's got even worse. This is a completely virtual PD Day, and one of the things that we really enjoy from our PD Days is actually getting to sit together with you, advisors, and advisors interacting with each other. It's a real shame that today, from a compliance and educational point of view, we have to have ongoing PD Days over regular periods, and having to do it virtual is disappointing in that context, that we can't be together and we can't sort of come together and share lunch, share a drink, and share the interaction that you get between advisors. So apologies for that, but thank you for all logging on to the virtual side. I think there's how many are logged on now, Cosette?
293.
So 293 advisors logged on virtual. It's just an amazing performance in respect to your commitment to your education, and I thank you for that. The regulator and the industry is continually talking about education being the critical point for all advisors, and I think we're leading the way across the groups, and I think that's just a dedication to each one of you and the team. So thank you. We've got a very busy couple of days. I think the first speaker I'd like to introduce from Perpetual is talking about economic matters, and James Holt is one of the great people in respect to understanding the markets, and in a COVID environment, getting a feel with how the market's going to come out of COVID and all the things that are happening in our economy. I think it's a great starting subject. There is a chat line, a chat box on the website. So if you have any questions, we'll make sure that we do leave a bit of time in this particular subject so you can ask questions along the way. And if any particular questions come up during the session, James will have access to that, and he may look to answer some of those along the way. So thank you for our partners at Perpetual. Zenith rated Perpetual the Fund Manager of the Year. Someone like me who's been in the industry for too long, I remember 25 years ago supporting the Perpetual Industrial Share Fund as one of my go-to funds when I was advising. Perpetual has continued to lead the market in their defensive strategy and their ability to get performance in good and bad markets. And I'd like to welcome James to talk to us about the economy and what Perpetual think is happening. And again, thank you for all attending, and I hope you enjoy this session. Thank you, James.
Wonderful. Thanks so much for the introduction. And hear me okay?
Yes.
Perfect. Okay. I'll look. I've got about 20 slides or thereabouts to go through, so I'll go through them fairly. I didn't want to sort of do death by PowerPoint, but just sort of make the critical observations that we're seeing at the moment. But just look, a few things for us. First of all, clearly general advice disclaimer is always point number one. Zenith Investment Partners, as was mentioned just there as well. It's been great to get Fund Manager of the Year, so that's a wonderful recognition. But basically, what I'll talk about is essentially the economic environment. That's the majority of this presentation clearly and what you've asked me to talk about today. And then also at the end, I'll just sort of fit it with, because at the end of the day, we're investors. I'll just sort of fit that into the sort of companies we're looking at in this environment. It's obviously a bit of a dynamic, moving feast as well. So I'll sort of refer to that in addition as well. Perpetual, of course, look, just one little update here is just that you will see more about sort of Perpetual Group and Perpetual Asset Management International in Australia. That's simply because we've acquired Barrow Hanley in the United States, and also Trillium Asset Management in the United States. Barrow's a value manager like us. Trillium's more of a sort of an ESG type manager. But they do complement the domestic business, which has obviously been around for a long, long time. We've been around 130 years. The Aussie process has been around about 55 years. So we've got a range of capabilities, but it helps to sort of give us a 360-degree view of the world. It's shy of $100 billion. Hopefully that changes over time. But look, a couple of things we're just reflecting on. First of all, before lockdowns happened, clearly, business conditions were exceptional. There's no doubt about that. So you can see they're peaking. They did come off a little bit. They've sort of bounced up a little bit in the last week or so. They're moving around, so I don't worry about sort of updating week to week or month to month necessarily every single data point, because obviously it's just very, very volatile. But the point I just wanted to make here really was that we were going into the middle of this year with these exceptional business conditions. And we look at business conditions, we look at a range of data, obviously, but one advantage of business conditions is that sometimes confidence can be a little bit noisy, and conditions can often lead ahead and just say, look, well, even though the confidence is not quite there yet, the conditions have improved, and maybe that's a better guide to how the economy is looking. So I think there's a number of things that sort of buttress that. The lockdown didn't help clearly in terms of business confidence. That's why it came off a bit, but it's still above the levels that before COVID even took place, and it is sort of starting to return to those elevated levels again now. And it's a range of things. It's the fact that the stimulus was so successful. Consumer confidence is pretty good. Lockdowns are never great, but there's also winners and losers from lockdowns. So clearly, the people who couldn't attend work or things were difficult, clearly not a good thing. But at the same time, one thing the RBA has got its eyes on, and the Federal Reserve in the US as well, is that during lockdown, there's a big build-up of excess savings. And the excess savings in the Australian economy coming out of this lockdown are around about $260 billion. So that's the savings over and above what would normally be there. So clearly there's pent-up demand to that 10% of GDP still in the system. In the US, just FYI, during their recent lockdown, they had excess savings about 2.6 trillion. So not just the stimulus, large part of which was spent, but these savings get built up. And that's why we have these sort of quite strong recoveries coming out of lockdown once they occur. And as I mentioned, look, I think we did a pretty good job in Australia of doing the fiscal stimulus very powerfully last year. It was cut off in the first quarter of this year. I think that was probably right. I know in the US, they're debating additional stimulus measures up to $3.5 trillion. To put it in context, I mean, our stimulus is probably about 10% of GDP. They've already had about 10, 15, 20% of GDP. They're talking about another 10, 20% of GDP, which means their total program will be around about 30, 40% of GDP or even more, which is probably too much. But, like everything in America, they do it big, they do it over the top. But it's also why I think we've seen this kind of beginning of this inflation story start to emerge, and I'll talk a bit about that later on. But as I probably, I think the thing to prepare yourself for is that the global economy, in one respect, is preparing for this sort of post-war boom. I think we will have these boom conditions on the one hand, but also inflation. So if you think about COVID as a war, it's a war. Always after a war, you get this strong bounce in activity. We've been locked down for too long. The boys have been fighting overseas, whatever. People come home, they want to spend and put the bad times behind them. COVID's had a similar sort of effect. But there will be clearly dislocations and inflation that come out of it as well. So we're certainly prepared for that, and we're invested accordingly because we want to be invested. We last year, about a year ago, we said there's going to be inflation coming out of this. Everyone said it'd be transitory. No, we think talking to the CEOs, rather than listening to an economist sitting in the RBA, we'd rather listen to the CEOs on the ground. And they were all telling us they've never seen the conditions for inflation quite like this in their careers. So we did invest in a lot of miners, copper, nickel, anything that could sort of benefit from this this surge in inflation. We've still got those positions in place. Some of them have doubled and trebled and quadrupled. But there is still this sort of bottom-up support for a lot of those positions that we still see today. Obviously, the money printing was huge, whichever way you look at it, and clearly, you know, there's no way you can't have inflation coming out of this. I think it's also important to put this in context. What is clearly being quite distinctive is that when you do technical QE, that is simply asset transfers between the Fed and the banking system, it can inflate asset prices. I think that's been the phenomenon of the past 10 years, but it really did nothing for the consumer on the ground, and it didn't really result in any inflation for the consumer on the ground. What the COVID response has been, it's been completely different. Effectively, it's gone from technical QE, bank QE, asset QE, financial system QE to people's QE. The money was put straight into people's hands through unemployment benefits in the US and Australia, or the connection to work payments, which have been used around the world. And clearly putting cash to people's hands rather than putting money into the banking system, the impact has been enormous, but it's also been inflationary, and the money's sitting out there. This is money creation. This is not, you know, a sort of a technical creation. With QE off, what happens is the Fed may inject the cash into the bank, but then it buys assets and pulls the assets out. So it's effectively swapping assets. It's not adding to assets in the system. Whereas in the case of COVID, they've simply put the money into the system and into consumers' hands. And we've seen the result, which is this extra stimulus, a dramatic recovery, but also inflation and all the other things. Look, it's been incredibly effective, as you can see here. You know, we talk about U-shaped and V-shaped recoveries. Notice that not exactly, but generally there has been this phenomenon over time that, you know, look, the recessions seem to get longer and longer, and the jobless recoveries seem to get longer and longer. And you can see there 2007, which was obviously a biggie, and 89 was a biggie. By the way, 89 was caused by a smaller version of the GFC. But you can see there, we recovered slowly from those events. The tech wreck was more of a corporate recession rather than a consumer recession. This time, if you looked at the first half of that V, you would assume that COVID would absolutely wreck and set new records for slow recoveries. In fact, it's a testament to the quick action of the Fed and the governments that this became one of the sharpest Vs of all time. And in fact, within 18 months, sort of about now, towards the end of this year, most economies, we're already fully recovered, but the US and others are also within range in the coming months of a full recovery as well. So it has been a V, which is good, but also it does present some potential challenges. And I did like this analysis from Deutsche. And the CBO, which is the Congressional Budget Office, Deutsche has a baseline estimate as well. So CBO only sort of looks backwards. Deutsche here are putting in a forecast, a baseline, but also a high growth forecast for what you know, stimulus might mean for the US. And of course, as always, everything that's happening is happening in the US first, and then it's sort of spilling out to the rest of the world. These shortages and inflation and those sort of issues happening in the US, but then they're hitting the UK, then they'll eventually come to Australia. It's all coming here as well. So hence why we're preparing for all this stuff. But you can see here one scenario, and a lot of this relies on scenarios. So the high growth scenario is, what if people spend a bit more than expected of their excess savings, of their stimulus packages? What could the recovery look like? And US output gap, which is often very hard to explain to grandma, but output gap basically is where the economy is in relation to its potential. So sometimes an economy runs below its potential, as you can see when the blue line is below the dark black line. And that's, of course, during recessions and periods like that where we could be growing a lot faster. We've got the capacity to, we just can't get there. But we can also have excess capacity. That's when the economy is running ahead of where it should, in theory, potentially be. And of course, that happens usually at the end of a cycle. That's usually when employers are squeezing lots of productivity out of their workforce, the economy is running hot, savings are going down, spending is going up, and the reserve banks, the central banks, have to step in and actually start raising rates to try and stop the froth spilling over the top of the economy. So it's normal for an economy to have a bit of excess output gap towards the end. You can see it happened in the 1990s. The output gap was a bit above potential in sort of 98, 99 before the Fed sort of started to ratchet up interest rates, and then it slowed down, and naturally you wind up with a recession. So you only run hot for so long before the engine burns out, rates rise, and ends the whole thing. And in fact, notice even before COVID hit, we were already at excess capacity. The output gap was was in excess territory before COVID hit. So there was a big question mark about whether or not we could have actually had a recession partway through 2020. We'll never know because COVID got there first and just shut down the economy. But it's possible the Fed might have raised rates during 2020 and the economy just could have run too hot. And then you would have had a sort of the economy fall apart just before the election. Didn't happen simply because other events intervened. But the point of this is to show that, look, under a baseline scenario, we're looking at an economy with pretty high excess output gap anyway. But in some scenarios where there's lots of pent-up savings, people spend a lot of it, you get this big boom coming out of this latest lockdown in the US, and all of the stimulus that's been applied, the output gap could be as high as nearly 6%. Now, the reason that's causing some consternation is because that would be the highest output gap since 1965, 56 years ago. And the last time it happened, when we got the output gap that high, what happened in 1965, you may ask? That was the Great Society. Remember, Lyndon Johnson was trying to abolish poverty. He put a tremendous amount of stimulus out there. The Democrats are trying to do a similar thing today. You know, this $3.5 trillion is about childcare and it's about other things. They've got 1 year to change everything, a bit like what Lyndon Johnson did in 1965. And if they overdo it, we might wind up with an economy just going too hot, and that could result in inflation and all those sort of things, because 65 is the beginning of the inflation problem for about 15 years in the US. The oil price hikes didn't help either. But again, that's something to be aware of, that we're looking at scenarios where the economy is running the hottest it has been in more than half a century, and it could spell trouble down the track as well. Look, growth, I think, sometimes I don't, always necessarily look at GDP growth, as strange as that might sound, because there's technical factors that could push it up and down. But I think at the end of the day, what people really feel on the ground is employment. That's the data that's important. And look, hiring intentions, as you can see here. So to read this graph, you've got the unemployment rate there in light blue, and hiring intentions is an index, but it's been flipped over so that you can correlate hiring intentions with the unemployment rate. And the hotter that hiring intentions are, as you can see there in dark blue, the lower the unemployment rate is. It's obvious, it's natural, it's logical that there's a very tight relationship between these two things, because the more people intend to hire, they hire people, the unemployment queue goes down. It's a very tight correlation. And you can see there, again, the thing that is a bit of an eyebrow raiser is that the unemployment rate's still about 4.8% as of a couple of Fridays ago. So it's okay, but the hiring intention, so this is businesses saying, we want to hire in rates at which we've never hired before. And if you look at similar other surveys, there's a job openings survey in the US, which currently suggests that businesses want to hire 10.5 million people, which is about 3 million more than it's ever been in history. So the hiring intentions, the intent of employers, the desire to employ people is absolutely off the scale. And if this correlation holds true, the unemployment rate should be heading very rapidly towards the end of this year, beginning of next year, towards an unemployment rate of 1%. We've never seen that before. Now, will it happen? Who knows? The future is unknowable. But my point is, if we look at very clearly correlated data here, the hiring intentions, which seem very real, people say they just cannot find workers, 10 million jobs out. There's only 8 million unemployed people. There's 10.5 million jobs that employers need to fill. People have retired during COVID, as they always do during a recession. People bring forward their retirement plans. Those hiring intentions could come down and the unemployment queue could go up. But right now, it's suggesting that there's this, the hiring intentions, the unemployment rate's going to run into each other. People just had this massive expectation about who they want to hire, how many they want to hire. The unemployment rate is just nowhere nearly, there's not enough unemployed people to fulfill that. So I think keep an eye on the labour market, because that's where the action will happen. And although the month-to-month data can be disappointing, so the 194,000 jobs created in September was a bit of a disappointment. It should have been about 400,000. which was at odds with the private data, which was about 500,000 the day before. So it didn't really make much sense. But often what happens is next month when the unemployment data comes out, watch if they revise the jobs from the month before. Often they do. They suddenly find that there's 200,000 employers who reported that they actually hired in September that didn't report it. They probably didn't report it via the surveys because they're just too busy trying to service their customers. But I suspect the jobs growth underlying the economy is a lot stronger than people realise. The intentions are there. The unemployment queue is quite low, and you could see this quite dramatic lift. And the other thing to look at is wages. So wages last month rose in the US at 0.6% for the month. Now, it's always dangerous to annualise 1 month numbers, but if you annualise that, that would imply wages growing at about 7% per annum, which is red hot. So again, we don't know where exactly all this stuff will fall, but maybe wages start to really heat up. You've got this really hot labour market. That's sort of the boom froth, the froth spilling over the side of the glass. You know, output gap is at very high levels. That's where you get the Fed step in and start to raise rates because the economy is just too strong, much stronger than expected. And so that leads me to a little bit of this inflation for longer. And look, early on, people talked about the base effects of inflation. So yes, prices fall, but then they rise, and the inflation looks a lot higher. From January 2020 to January 2021. Don't worry about it. It's transitory. It's used cars. They'll come back down to earth again. And look, we agree with all that. We didn't dispute any of that stuff, but we just said, look, there's additional things to think about. People for a start, this new fiscal policy program, we're getting away from the 10 years, 12 years of relying on monetary policy. People now have used fiscal policy during COVID, and it has been incredibly effective, maybe so effective, too effective, that they're now addicted to it. And any sort of problem that emerges, we could go back to that. Secondly, I mean, the Democrats are already planning another $3.5 trillion, as I said. It may not happen, but there's so much stimulus that's gone through the system, and I think it'll be the go-to policy of future recessions. Secondly, house price rises in the US are at 30, 35-year highs. They're bigger than during the housing boom of sort of 15 years ago. So, and when house prices rise, it leads to higher rent, which leads to higher inflation because rent is 40% of the inflation basket in the US. Thirdly, there's the upward pressure on wages that I've already talked about. Now, the reason the 1970s inflation became so bad is because you had prices go up, unions made big wage claims that pushed up prices even more. You had this wage price spiral. Now, it's early days. We don't know what's going to happen, but that's exactly how the 1965 inflation started. 1967 to 1970, US inflation was about 5-6% per annum. It was hard to get back down again. By the time it did get a little bit under control, the oil price hikes hit, and it's hard to tell exactly what caused what, but we think that's something to keep our eyes on. The trade war is reversing. 30 years of globalization, very, very important, because I think you can't have your cake and eat it too. You can't claim. I think part of the reason inflation's been low is because globalization has helped keep the price of goods low. I accept that, and everyone talks about that, but people then want to say, oh, well, 30 years of globalization has kept prices low, but now deglobalization won't see prices rise. Isn't that the logic has to hold together? If globalization has been part of the reason inflation's been low, then deglobalization should be part of the reason inflation will be higher, potentially going forward. And then also demographics, costs of aging, and the healthcare system. Again, the healthcare system is a big component of the CPI, and that's the sector that's really inflating quite rapidly. And also, look, the baby boomers. You see, Bill Clinton was hospitalised the other day for an infection. He's the archetypal baby boomer, born in 1946, 75 years of age. The baby boomers are this is the midpoint where more than half of all the baby boomers between 1946 and 1965 start to retire. So I think the pool, that huge pool of people forming the baby boomers, which have kind of driven most social trends in the last half a century, I think they start to have an impact now as well on the savings system. They're not going to be contributing to super, they're going to be drawing down on super. And that probably means net high yields as well. And lastly, decarbonisation. Look, I think decarbonisation probably has to happen anyway. It'll be a 30-year story. It won't happen overnight. it's partly driven by the fact that solar and wind, but especially solar, is far more cost effective than people probably thought just a few years ago. In fact, solar costs today are sort of where they should have been at about 2035, to put it in context. Now, it'll take trillions of dollars. It'll take trillions of dollars in several decades to install solar, wind around the world. We'll need some nuclear as well, and a few other things to keep the kit system stable, but keep baseload power in place. But struggling to find estimates of how much this whole thing costs. It costs somewhere between 40 and 60 trillion dollars, but the money just can't come from nowhere. Clearly, we've lived in a world where savings have been too high. We might be heading into a world where investors need to provide higher and higher interest rates to attract the capital to do a lot of these things, which I think can be quite expensive. Just turning to China, sort of away from the US into China, just a couple of things here. First of all, I put on the left here, this is just kind of the cyclical, regular, everyday story. So the China credit impulse, which is just credit growth, and Chinese nominal growth, you can see they're reasonably correlated. And so basically, like most economies, where the credit cycle goes, so goes GDP, up and down, up together, down together, about 9 months apart. Now, this is a bit of a choose your own adventure story, because what's going on in China? Well, what this is signaling is that credit growth has been shrinking anyway. It's in negative territory. As you can see, the grey, the sort of khaki line is in negative territory, measured on the right-hand side, -5%, which is basically where most credit cycles in China bottomed in 2018, back in 2014, back in 2010. And so nothing is out of the normal there. And growth as a result will now fall in line with credit growth in the next 3, 6, 9, 12 months, as it has in times past, in all likelihood. What's the government trying to do? Well, look, if credit growth is sort of shrinking anyway, why don't you kind of take it upon yourself to, step on the downward trajectory of the economy anyway? What's the government trying to do? Who knows? But I think given that they were already seeing an economy, credit growth in decline, they use it as an opportunity to maybe step in, crush the property bubble, try and crush China's reliance on property, which is 28% of GDP, too high. And if it's already happening anyway, why don't you just try and take control of events and say, look, this is part of the plan to clean out the economy? I think either one of those events, I think they're sort of influencing each other. So the credit growth is already shrinking. It's a very cyclical economy, China, far more than you would realise from the growth numbers. Property market's in trouble. Why don't we just reform the property market at the same time and sort of try and push all these dodgy lenders into either bankruptcy? Evergrande and Fantasia, which I think is a great name for a property developer, are obviously both in trouble. So this was kind of going to happen anyway. And I think in part the government's just trying to be seen to be in control of events. On top of that, I put on the right-hand side here this sort of more structural thing going on. You know what? If you want to read a really good synopsis of it, Kevin Rudd, he runs the Asia Society these days. He's a China expert, but he's put together an 8,000-word document on what's going on in China, the new economic policy of Xi Jinping. It's worth looking into because, you can more or less break China up into sort of 3 eras now. There was the 1949 to 76 era, characterised by struggle, trying to establish themselves. There was all sorts of dramas. There was the Cultural Revolution. There was the Great Leap Forward economically. They were all disastrous, but effectively it was really about Mao trying to, establish the Communist Party, struggle, do away with the bourgeoisie, try and, create, give a bedrock for communism that couldn't be knocked off and whatever. Made lots of mistakes. There's various interpretations of that era. Once he died, if you like, the conservatives or the reformers took control. That's Deng Xiaoping, and introduced a 40-year era of to get rich is glorious. It doesn't matter if it's a black cat or a white cat, as long as it catches mice. That was simply code for, look, we've had this period under Mao. We've now got to try and improve the lot of the average person. The best way to do that is capitalism. The Soviets tried the same thing in the 1920s very effectively. So they adopted market socialism, and that's the era we know very well. Look, it did result in problems though. Clearly you got tremendous economic growth, but tremendous inequality as well. And that era has more or less come to an end. And what Xi Jinping is talking about now, you'll hear this term a lot, is this era of common prosperity. And what that means is, he said, look, we've had the struggle era, we've had the era where we've now got rich. We've now got to make sure that everyone has a share of it, and that's common prosperity. That's why he's attacking the internet companies. It's why these actors and these wealthy people are just being disappeared and reappearing as much more humble citizens, because he's sort of slapping them all around and saying the era of get rich is glorious, get over it. We've had it, it was successful. We've now got to try and introduce common prosperity. So no more running around the world in a private jet showing how many diamonds you bought at Tiffany's. It's more important to try and improve the common lot of China. So that's obviously a big shift, and I think people are still getting their heads around it, but it's a massive shift. Look, in part, he's got to get re-elected next year when the Communist Party meets, and so this sort of appeal to the bottom 80% of society, I think, is also helping to cement him in place for a third term and probably probable life term as president of China. So it's a bit of politics, it's a bit of genuine belief, it's a real view that he thinks he's heading into this sort of third epoch that should take China through to 2049, and the communist mission is solved. They had 30 years of struggle, 40 years of growth, now 40 years of redistribution and the improvement of society. And of course, the old policy of hide our strength, bide our time. Now, Xi Jinping, I've just quoted him here, we still stand tall and firm in the East. You know, that's the new policy as well. So if anyone who's got a sort of, harking back to the old era of China for the past 40 years, that's pretty much over. It's this new era. It's been a little bit subtle, but be assured it's a big change that's underway. In terms of the markets, how the markets see all this stuff, well, clearly the Chinese market's struggling a bit. It'll adjust and work out new ways to price all that stuff. But also, look, even in the booming West, we've still got issues, right? We've got the margin debt to GDP, that's been peaking at all-time highs. More concerning for us is the penny dreadful trading stocks. The trading activity around that has been surging in 2020, 2021 in particular. Robinhood users, this great trading app, have taken off like a rocket. The performance of non-profitable tech stocks, taken off like a rocket. So they're all indicators that, during COVID, everyone's turned into a fund manager. So we've got millions of fund managers out there now sloshing all this money around the world into these different asset classes, and it's added to volatility. And we've seen Tesla, take off and fall and then recover again. Afterpay, clearly, it's been an incredible story. It is now being bid for by Square Capital. Whether or not that proceeds, who knows? Who knows? We really don't know. But it's not a lay down misere. Bitcoin, Ethereum, Bitcoin's back to record highs now. Ripple, Dogecoin. There's another one out there called Pirate Coin. I hadn't heard of this until someone mentioned it to me. The ticker for that is ARRR, which I thought was very clever. But it was a few cents one day, $17 the next, then crashed back down to earth again. How do you price this stuff? I think it's really, really hard. Digital currency is here to stay. Whether or not the Bitcoins and the Ripples and the Dogecoins and the Ethereum stay is one thing. It could happen. I think the Fed and the Treasury are watching all this and just saying, let's just see how it plays out. But I think eventually the government's going to want to control it, regulate it, and probably eventually just replace it with its own digital currency. But I think, there's no harm in watching to see how this stuff plays around, as long as it doesn't become too big a part of the economy and blows the whole thing up. SPACs, special purpose acquisition companies, that's been a thing as well in 2020 and 2021. It is sort of dying off now. This is people coming in and creating a company for no apparent purpose apart from the fact that it might do an acquisition down the track. A lot of investors have set these up over time. You can see there's a few billion a year gets raised for SPACs. So that, raise the money. Don't know exactly what we're going to acquire yet, but we'll think it's something that'll be good for you guys. Think about it as a blank check, a blind trust almost. So that's certainly been out there. But you can see the boom the last couple of years. And look, what's happened is we've also had rap singers, quite a few celebrities start to raise SPACs. That's usually a bit like the old taxi driver giving a stock tip's a bit of a sign that maybe it's gone a bit too far. And the returns from SPACs, as you can see, they've been pretty ordinary as well. Leverage and blow-ups, Melbourne Capital, they were short GameStop. The Reddit crowd, there's millions of new fund managers sort of swamped in, pushed GameStop up. Was it market manipulation? Clearly, but what are the regulators going to do? Maybe they'll try and shut down or regulate some of the Reddits. They might give speeding tickets to a few of the people sort of promoting the schemes, but they're fearful to tread there because obviously it's a bit of a political thing, and the haves versus the have-nots as well. But clearly, it's caused some volatility. Archegos, that was the guy who ran Archegos was done for insider trading some time ago, so we can't actually have an asset management company. But Archegos was actually a family office, so even if you've been done for insider trading, you can still in the US set up a family office, manage your own money. He had $10-12 billion, but he was massively leveraged 3 or 4 times over. Was long tech and was short a handful of value stocks. And unfortunately, when the value rally occurred, he just got absolutely smashed. He lost his entire fortune overnight. Probably one of the top several personal greatest reversals of fortune in economic history, I'd say. We'll go back in hindsight. Greensill Capital, whenever a billionaire appears from nowhere and suddenly they're all over the papers, it's always a red flag for us. And look, that's not to say that Lex Greensill's business, the idea of supply chain financing, you think about it, you've got a small business that's waiting 30, 60 days for money to come in from their suppliers, or they've supplied something and they're waiting for the cash to come in. They can have a Greensill provide credit to cover that period. It's actually a good idea. But what happens, of course, when you start doing that, the next thing you become a multi-billion-dollar company, and the risks and the return requirements are very large. You don't know where to put your money, and you make bigger and bigger deals, and there are bigger risks, and those risks could blow up, which is exactly what's happened with Greensill. And eventually, if you can't get insurance, as he couldn't, that was the trigger for going down. Remember, most investment schemes in history, it's all fine until someone somewhere just says, hang on, this doesn't make any sense. We're pulling credit, and the whole thing comes down like a house of cards. And same sort of thing happened with Evergrande, I guess, as well. So we had there, obviously, a Chinese developer overextended, and we know the rest is history. Interest rates at the moment being incredibly suppressed by the Fed. So you look at the last 10 years here, the light blue line is the global manufacturing PMI. You can see there the Treasury yield in dark blue. The Treasury yield should be closer to 4%. Now, maybe eventually global PMI is already in decline, right? They're coming down. And maybe the 10-year yield won't go up, but it might be a bit of both. But clearly, the natural market mechanism isn't quite in play at this point in time. What's Jerome Powell going to do? The argument has been that he's going to wait until he gets selected as Fed chairman in February, or if he thinks he's not going to be reselected as Fed chairman, he might just start to allow rates to rise. That arguably has been happening the last few weeks. You might have seen the 10-year US bond yield is now 1.65% as of today. The Australian 10-year is at 1.8%. So 10-year bond yields have been drifting up quite substantially. And I think that reflects more where the market pricing should be on all of these instruments. If bond yields do continue to rise, given we're in that super boom phase of the recovery, I think you want to be invested into energy, you want to invest it into mining, things like that, and less invested into retail, health, and those other expensive sectors. That's certainly where we are at the moment. And something as well I think worthwhile bearing in mind, you can see here, this is Australia, but it's also true of global. Value stocks there around about 15 times. Growth stocks, you can see there, they're much higher than normal. And in fact, the last time that this expensive was in .com, 25 times, about double the valuation of value. Now, note that even growth stocks go through these derating periods. So what happened to the .com bubble? Well, eventually a lot of those stocks just became normalized again. And I think that's the thing to be aware of. Value stocks can't really go much lower. They sort of naturally just grow over time, and the valuation stays about the same, but you get earnings growth and they creep up over time. With growth stocks, they go through booms and busts, and they've had the boom, but we're only 10% into the bust. And I think, again, that's where I'd be wary about an Afterpay or a CSL or these sort of companies. It doesn't mean they're not good companies. You can have quality companies that simply come down in price as the bond yield tends to rise. And I think we haven't had that phenomenon yet. But if we do get the normal market history mode, especially if there's higher inflation, these things could come down a lot further than they are. And I think so far we've had the value stocks rally, but we haven't had growth stocks go bust yet. I think that's yet to come. Value's obviously long-term been the big winner compared to growth. As you can see here as well, we're 18 months into a value rally. The last one lasted 72 months. That was 2009 to 2015. So I think there's a long way to go before value runs out of puff. And I think you want to bear that in mind as you're investing. And you can see here again, we're partway through this whole phenomenon. So for us, we look at 450 companies. We screen out low quality companies to get rid of about 170 companies. We have 280 quality companies we look at. And the final portfolio for us is picking the best value, if you like, from that 280. We rank stocks from 1 to 5. 1 and 2 are the best value. We don't have a rank 3, 4, and 5 are the least best value. And that's how we build our portfolios. And so look, how it looks today, and that's a summary on the left, obviously, debt of value, greatly exaggerated, has clearly come back. Boom conditions are here. Rates, we suggest, will rise. And that'll be the next leg of the market rally. But in terms of the particular things we're investing into, obviously overweight growth, underweight bonds. And in terms of stocks, they fall into 4 broad categories. First of all, the normalisation trade. So we do like Qantas, we still like Crown, Aristocrat, Event, Dexus, those sort of positions. We think they're underpriced relative to what normalisation looks like. We're long insurance. The banks have rallied really hard, but the insurance companies have been left behind. Suncorp's had a pretty good rally, but IAG in particular has not had the rally at all. Now, contrary to what a lot of people think, the insurance companies benefit from higher rates. It reprices their back book. So there's a positive correlation between higher bond yields and insurance companies. You wouldn't think so the way that IAG has been trading, but that's still very, very true. Long industrial materials, we've had a lot of stocks here. We're starting to trade out of them though. So Boral, first of all, has been sold to, has been taken over by the team by Seven, by Kerry Stokes. So we've sold into that. Also, BlueScope Steel, we had a great run in BlueScope Steel. We've just recently sold that as well. And Fletcher Building still a bit of a position, and so is Incitec Pivot as well. So look, I'd say we're still long the normalisation trade, long insurance, long a few of these industrial materials, and we're still very long the metals. So copper, nickel, mineral sands, those sort of businesses. Luca, we still think it's very well positioned. Western Areas is well positioned. Oz Minerals, and also Deterra. We've had very little exposure to iron ore. We've got no Fortescue, we've got no BHP, no Rio, I should say, underweight BHP. So we've been very underweight iron ore. We don't think the whole thing has played out yet, but what iron ore exposure we did have was a small exposure to Deterra, which is almost like a low beta way to play the iron ore market. So I hope that sort of is a benefit. It sort of positions how we're looking at the world. And I've got a few minutes left, so happy to take any questions people might have or entertain different views.
Thanks, James. That was a really good presentation. Every time Perpetual present to Interprac advisors, it always is one of the best received ones, including the economic one we did early this year. And once more, a really great insight into investing in China and what's happening in world markets. Thank you again, James. That was really great.
Absolute pleasure. No worries at all. Always a pleasure to present to you guys.
No worries at all. And Elise Mattman will keep us on our toes. I'm sure she'll chase us through all the list of the people who are interested in your products, and we'll make sure we partner her well. So thanks again, Perpetual, and especially you, James.
James, sorry, there was just a question that came through from Gabe Carey. What's your view on the renminbi versus the US dollars, given the likely China stimulus?
Yeah, look, it's a good question. I think currencies can do very funny things. I reckon it's the hardest single asset class to predict. There's no natural return with currency, because if you take yields, cash rates, and bonds out of the equation, and sometimes the US dollar can be depending on the circumstances, can either be a safe haven or it can be the center of the crisis, so to speak. Look, I would say short term, I reckon it's just too hard to predict what the impacts might be. But I would say this, we've got to get a sense of what's going to happen with the renminbi over the next few years. And I'll contrast it this way. Remember, what's the yen trade at? About 100 to the US dollar. If you only go back 30 years, the yen used to be 380 to the US dollar. Arguably, the yuan, Chinese yuan, renminbi, shouldn't be 6.5 or 6 to the US dollar. It should be about 2. If it was, by the way, or at least 3, double what it is, China wouldn't be a $14, $15 trillion economy. It'd be a $30 trillion economy. It wouldn't be $6 billion smaller than the US. It should be, about $5, $6 trillion bigger, $10 trillion bigger than the US. The great mystery is why the Chinese haven't acted in their own interest. From a PPP point of view, that is where you take out currency, China's already bigger, but in real US dollar terms, it's still smaller by a few $1 trillion. So I think, and the answer is that the Chinese have effectively said they thought the US put Japan into a trap in '85. So the US forced Japan into appreciating its currency. And they think that caused all of Japan's problems for the last 30 years. A little bit true, not really. I think there's other issues at fault there, but basically China has been quite happy to sit irrationally with this lower currency that keeps them quite competitive. And I don't know exactly what their plan is, but if they were really smart, they would allow their renminbi to drift higher, a lot higher, and it would turn Chinese GDP and even in US dollar terms into a bigger economy. And you know what? You think about how much sense it makes, right? All the imports they need become cheaper and cheaper. And effectively, China's given up on the export economy. They're assuming the trade war's here to stay. That's partly why you're seeing this big shift in policy in China, because they think Biden is just as bad as Trump and the era of cooperation and trade and all the rest of it is over. So in the short term, I don't think there's many implications. I don't think it really makes that much of a difference, and the US dollar could actually be a little bit of a safe haven from a financial crisis point of view. But I'd keep your eye on medium term what happens, because if there's someone economically savvy who takes control of China or who winds up as the finance minister, they may let the renminbi drift up, and it has all these benefits for the Chinese economy, especially now they've kind of given up on exports. Because you think about it, imagine if our currency was 25 cents to the US dollar. We'd have a huge trade surplus, But you know what? No one would ever go on an overseas holiday because it's unaffordable. We'd never import stuff from overseas because it's just unaffordable, right? So our dollar being 75 cents is good. It gets the balance right between exports and imports. And at the moment, China's just still got this ultra cheap currency, like Japan had in the 70s, and it's never really confronted the fact that allowing the currency to go up can be of huge benefit to their consumers. I'm quite mystified as to, they've got this thing in their head that the US put Japan into a trap in the 70s, and it's not really rational.
I think, James, it's one of those indicators, and having spent quite a bit of time travelling through China, that you've got to take into account that their short-term belief is 10 to 15 years, so they're still thinking a couple of decades away when they start thinking about the valuation, and they will outlast us in that regard.
100%. You're so right. There's a 100-year plan from 1949 to 2049. So that's still a few decades away. It's all about that. Yeah.
As opposed to Russia's 9-year plans that lasted about two years at a time. So.
Yeah, that's right.
Thank you, James. It gives great confidence when investing in Perpetual products to know that they have a person of your calibre guiding their investment strategy. It's really reassuring and gives the advisors great confidence in choosing Perpetual as one of their preferred fund managers. Thank you, Perpetual. Thank you, James.
Absolute pleasure. Thank you.